Good afternoon, everyone. Thanks for joining us for our Small Cap Tech Conference. Hoping to do a few more of these in the future. We feel that Canadian small cap tech is not getting a lot of attention, so we'd like to increase that exposure via some online conferences. I'm Deborah Honig. With me, I have Victoria Rutherford and also Mathieu Martin, who kindly has offered to provide a keynote session for us to kick things off. Today, we'll have three companies presenting after Mathieu, which are Tantalus, Wishpond, and Data Communications Management. Victoria and I will handle Q&A for all of those, and also some Q&A for Mathieu once he's done his presentation. As always, this session will contain forward-looking statements. If you'd like to know more about those, you can find them on the company's presentations on their respective websites. And there will be Q&A, so feel free to enter your questions in the Q&A box at the bottom, or you can send them to Vic or I. With that out of the way, Mathieu, I'll turn it.
Thanks, Deborah. Thanks, Victoria, for having me. I'm very excited to be here, and thanks to everyone for tuning in. As Deborah said, my name is Mathieu Martin. I'm the portfolio manager of the Rivemont MicroCap Fund and also author of the Stocks and Stones Substack newsletter. Managing the Rivemont MicroCap Fund is my main occupation, my full-time occupation right now. It's a small fund. We're based in Montreal. We only have 8 million of assets under management, which allows us to play in the really, really small microcap companies. So our strategy is to find the most undiscovered and most promising growth opportunities in Canada. And typically we can find them when they're very early stage, very small, because we have low level of assets under management. So that allows us to be liquid even in the really small names. Just before we start, quick disclaimer that this presentation is for informational purposes only. Nothing I will say today is investment advice or recommendations. So I decided to title my presentation Death of Microcaps with a question mark, and question mark because that's what we'll try to find out. So we'll just start with an overview of what happened in recent years in Canadian microcaps. So first of all, if we look at the chart for the TSX Venture Index, you can see it declined a lot over the last few years. The index peaked in February of 2021 and experienced more than 50% drawdown, bottoming in November of last year. And as you can see on the right-hand side of the chart, it's starting to rebound a little bit, although it's very early stage in this recovery so far. Now, if we look at the trading and financing data on the TSX Venture specifically, all the data I will compare to the peak year in 2021, so 2 years ago. So if we look at the data for last year compared to 2 years ago, there are two different pieces of data that I typically look at. The first one is the equity capital raised in dollars. So that's the total amount of financing that is happening for TSX Venture listed companies. And that capital raised was down 60% last year compared to 2 years ago, and was also 30% below the long-term 15-year average. Then the second piece of data is the value traded. So it's essentially it's the trading volume, but in dollar terms. And that was down 72% last year compared to 2 years ago, and 41% below the 15-year average. So as you can see, both pieces of data are way lower than their historical averages. And it's challenging for both issuers and investors. For the companies that are publicly listed, it's hard to raise capital. And typically, these are companies that need to raise capital. They're in growth mode. And for investors as well, since the trading volume is depressed, it's hard to get in and out of these stocks. So on both fronts, it's been a really challenging market for companies and investors last year. Now, if we look at the year-to-date data, the same two data points for the first quarter of 2024, again, it's down year over year, 23% and 25%. So 2023 was a really bad year, and so far 2024 is even worse. So in aggregate, it's getting worse, not better so far in this year. If we just look a little bit at the US market, I've been comparing the large caps and small caps, large caps being the Russell 1000 index and small caps being the Russell 2000. And as you can see on this table, the large caps have outperformed for 9 of the last 10 years, including the 7 last consecutive years in a row. So you know it's really a large cap show right now, and small caps are really left for dead. So in a sense, the market sentiment is extremely pessimistic right now towards small and micro caps. It's been very challenging, and we're left to wonder if there's a light at the end of the tunnel. But in my opinion, there is hope. So we'll see why I think there is hope in the market right now. So first of all, several microcaps have been acquired lately. These are some of the logos of some of the main transactions that happened. I'm sure many of you will be familiar with some of these names, if not most of the names. Now, if we look at the M&A data in aggregate, I put this table together. This is an overview of 15 recent transactions in the Canadian microcap space. These are all non-resource companies. It happened in the last 9 months or so. And I listed all the important data: premium, the transaction value, the type of acquirer, and the valuation. So we won't dive into all these specific transactions. If you're interested in that data, it's available on my Substack. If you look up the post "Flurry of Acquisitions Part 2," that's the post where you have this table with my analysis on it. But if we just look in aggregate, the average premium paid was 63%. The average transaction value was about 200 million. And a private equity firm was a buyer in 9 out of 15 transactions. So private equity firms have been very active in the Canadian microcap space lately, and especially US private equity firms. So US private equity firms have been especially active in the technology sector. 5 of the 15 transactions from the previous slide were in the technology space, and they were all acquired by US private equity firms. And one of the hypotheses that I'm making after doing the analysis, one thing I noticed that's been very interesting to me is actually the last column on the right, the percentage of revenues from the US. These 5 companies all had a very high percentage of revenues coming from the US. So even though they were Canadian companies headquartered in Canada, some of them reported their revenues in Canadian dollars, but they were essentially US companies. They were selling a lot to the US. And I think US private equity firms like that because they know the end market well. It's the US market. And so I think that's part of the reason why these PE firms have been acquiring here, especially also with the foreign exchange rate that's been very attractive for US buyers coming to Canada. Now, if we look at some of the metrics, you can see that the growth rate on average was about 12%, so not necessarily super high growth. And it shows that you don't need explosive growth to be an acquisition target for private equity. And in terms of valuations, these companies were all valued based on annual recurring revenues, and the average multiple was 3.7 times. One other thing to note is the correlation between the valuation and the growth rate. So the lower the growth rate, the lower the valuation. The higher the growth rate, the higher the valuation. So that can give you a rough idea if you're looking at a microcap opportunity currently in the technology sector. Based on their growth rate, you can kind of extrapolate what kind of multiple of AR it could be worth. Although obviously it depends based on other characteristics like gross margins, customer retention rates, and things like that. Now let's just look a bit at the dynamics in the private equity market to try to understand why PE firms have been acquiring Canadian companies. So on this chart, this is a chart from Visual Capitalist. It was published late last year, and there are two lines on the chart. The green line is the private equity dry powder. So that's essentially the amount of cash that's on the sideline, the cash that's been committed to PE funds that's not deployed yet. And the orange line is the M&A deal value. So as you can see, there's a strong correlation between dry powder and M&A value. The more cash there's on the sideline, the more it gets deployed and the more M&A transactions there are over time. But this correlation has not held true in the last couple of years. And I think there are a couple of reasons for that. I think the main one is the rise in interest rates. As I'm sure people know, PE firms typically use a lot of leverage. They use a lot of debt to make these acquisitions, and the rise in interest rates have made it more challenging to finance those deals. And also maybe the macro environment has been a little more uncertain lately. So I think that's why PE firms have kind of refrained for now from doing very large deals, and instead they've turned to smaller opportunities. So I think that would explain why they've been looking at the Canadian microcap space with an average transaction value of about 200 million in the last 9 months or so. So what should we look for next? How do we position the portfolio at this point? This is only my opinion, but what I look for, first of all, strong fundamentals. I think right now it's safer to invest in companies that don't need to raise capital. As I showed before, the financing environment has been very challenging for microcap companies. That's not to say that no financings are happening. There are, but typically the terms tend to be more favorable to the new investors compared to the existing shareholders. So I for the most part, I try to stick to companies that are profitable, or if they're not profitable, that have a very solid balance sheet and a long cash runway. Then in terms of financial metrics, I'm personally looking for 20% revenue growth or more, but I think 10 to 15% at least is attractive, especially if they're cheap. So for tech companies with a software as a service business model, you can value these companies typically based on ARR. So if you can find them for less than 2 times ARR, and there are a lot of those opportunities right now in the market, I think that's very attractive, especially when you consider that PE firms have been acquiring in the 3 to 4 times multiple range. So that gives you potential upside of 50 to 100% if they get acquired in the short term. And if they don't, I think paying this kind of valuation for a growing company is going to do well in the public markets over time as well. And then for other industries outside the tech sector, companies that are profitable tend to be valued on P ratios or EV to EBITDA. And the comparable transactions from the previous table show that these companies have sold for anywhere from 13 to 19 times EBITDA. So if you're paying less than 10 times, it's probably a good deal right now. And finally, in terms of sector and geography, well, to me, tech looks really attractive right now. I'm seeing a lot of opportunities, even with the we had a little bit of a rally in the last few months, but still I'm finding a lot of opportunities below 2 times ARR. And if they have a high proportion of revenues coming from the US, to me that's a bonus. It means that they're more likely to be an acquisition target in the short term as well. So I just wanted to share a few reasons to be bullish on the Canadian microcap market right now. The first is that the fundamentals are strong. We're talking about microcaps here. These are early stage companies for the most part. I'm not saying that all companies are doing well. That's not the case, but the companies that were doing well before the bear market are still doing well for the most part. So I don't see any fundamental reason why these stocks should be down 50% like the TSX Venture Index. The companies that were executing are still executing. The inflation and supply chain issues are mostly behind us now, and companies are reporting strong financials. So that gets me comfortable investing in the space right now. The second thing is that the trading volume is picking up in some pockets of the market. As I showed on the previous slide, trading volume is down year to date, but this is anecdotal. This is based on my own experience, but I'm seeing more liquidity in two pockets of the market. The first one is what I call the larger opportunities, which is, to me, is 100 to 300 million market cap companies. These are the types of opportunities that typically are more on the radar of institutional investors. Maybe they have a few analysts from the investment banks covering them. And when the institutional capital is looking to come back to the microcap market, they typically enter the space through these kind of larger opportunities that are a bit more well-discovered and a bit more liquid. So these names, I've seen an increase in liquidity lately. And the second bucket is just what I call quality companies. So they can be smaller than 100 million market cap, but if they're growing and they're profitable and they're reporting strong earnings, these stocks have started to move and move on decent volume as well. So I would kind of focus on these two buckets at this point before moving on to perhaps more speculative stuff in the coming years. And then the third point is that stocks are making sustained moves following good news, which is something we hadn't really seen in the last couple of years. Companies would report strong results and nobody cared. But now it seems like people are starting to care a little bit more. I've seen companies report strong financial results and the stock moves 20, 30, 40% in a day. So I think that's a very encouraging sign. And even though we've had a little bit of a rally lately in some quality microcap stocks, I think the valuations are still really low in historical terms and also compared to large caps right now, way disconnected from large cap valuations at this point. So I think there's a lot of runway for multiple expansion over the coming years as well. So my conclusion is that Canadian microcaps are not dead. I think it's a great time to own them, to invest in the space. And I'm going to leave you with this question. Who would like to be a contrarian at this point and invest in an asset class that's been really overlooked? So if you want to learn more, the topics from my presentations, those are topics I covered in my newsletter. It's a free Substack newsletter called Stocks and Stones. I encourage you to subscribe. I'm also active on social media, mainly LinkedIn and X. I share every month the trading volume and financing data as it comes out from the TMX group. I share that on social media. I also share the acquisitions as they happen, and I write one article per week for the newsletter. And just one last point on the newsletter, it's called Stocks and Stones. Stocks because I talk about microcap stocks, and stones because I share some of my trail running adventures. I started doing ultra trail races a few years ago. Some say I'm crazy to do that, but I'm training for a 110-kilometer race this summer in July. So I share a bit about those adventures as well. It's a small part of the content, but I'm sharing mostly how I try to develop grit, resilience, perseverance, and I think those skills are very useful as a microcap investor as well. So if that sounds appealing to you, I encourage you to subscribe and follow me. And I look forward to connecting with many of you after the presentation.
Thanks, Mathieu. Appreciate the presentation. I would encourage anyone listening to sign up for the newsletter. It's really good. I read it every week. So yeah, thanks, Mathieu. I guess I have one question for you. What do you find more punishing, being an ultra marathon runner or a small cap investor for the past 3 years?
It's a tough one to answer, actually. Being a microcap investor has been really, really tough. I've been investing in this space for about 10 years, and definitely it's been the toughest 2 or 3 years that I've experienced. So yeah, it's a good question, Deborah.
One other question for you. So you spoke about what you're seeing in terms of like broader themes in small cap. Are there any like more specific themes that you're looking at, like investment themes that you're following in the tech space?
Not specifically. I mean, I'm a generalist investor, so I'll just try to go where I can find the most value. I typically don't tend to, I mean, I'm a bottom-up stock picker, so I'm just trying to find the best opportunities regardless of the sector or the team. Of course, if there's a tailwind or a strong team behind the company, that's even better. And typically you get multi-baggers by having that strong team behind a company that's executing. But it's more case by case. I don't have any specific thesis, like macro thesis right now about the sector in particular.
I had a question, Mathieu. I was just wondering, within the space, are there certain revenue models that you prefer when you're looking at different companies?
Yeah, well, I think I spoke a lot about technology. So the software as a service model, I think is very attractive. And I mean, it's no secret. I think generally investors are probably aware that this is attractive because you get recurring revenue. So it's predictable. It's typically high margin. And also, I think maybe one aspect that sometimes maybe overlooked by investors is the ability for these companies to operate with negative working capital. So if they charge for a 1 year subscription upfront, the client pays upfront, and then the service gets delivered over time. So when you look at the financials of these companies, the revenues are actually a lagging indicator because the cash has already been received upfront, and then the expenses are paid. The revenues and expenses are recognized over the course of the coming year. So these companies can operate with a large deferred revenue balance in the liabilities and essentially a negative working capital. So that's very attractive for these companies to be able to access non-interest bearing financing like that.
And then in general, like you talked about how it's been difficult in terms of equity financings. So how are the balance sheets of a lot of these companies? And you just talked about being able to operate with deferred revenue. Are a lot of these companies in the microcap tech space able to grow right now, I guess, given what's going on for their financial statements and their balance sheet?
Yeah, well, again, it's more case by case, but I think another beauty of the SaaS business model is that companies can scale back on expenses fairly easily. So I think we've seen a push to get to profitability for a lot of microcap companies that weren't profitable, and then they realize, oh, we can't really raise financing right now, so let's just push to get to profitability and sustain ourselves without having to rely on the market. So overall, I would say it's not been too bad. Obviously, like the smaller opportunities with lower revenues that don't have enough scale to reach profitability in the short term, those companies have been struggling more and more.
I guess my last question, since we have time, if your thesis doesn't work out, do you think like valuations are at a floor? Like, what's the downside from here?
Yeah, well, it's hard to see any downside. I mean, there's always potential downside. We never know what the market will do, but I would say I was more worried in the early part of 2023 when the market was just in free fall and we didn't know where it would bottom out. But since the acquisition started by private equity firms in the middle of last year, I think that's kind of put a floor on valuations at this point. And one interesting thing I can mention, when companies get acquired, and these were all cash offers. Shareholders of these companies get an infusion of capital, and they typically redeploy it in other opportunities that are similar. So if you get a lot of tech companies getting acquired, well, investors will redeploy that capital into other similar tech opportunities. So that kind of creates buying pressure for these other stocks that are remaining public. It's just like more money chasing fewer opportunities. So I think that's why we've seen an improvement in liquidity lately and kind of a floor on valuations at this point.
I don't have any other questions, Vic.
No, I'm good. Thanks, Mathieu, so much.
Yeah, thanks, Mathieu, for presenting to us today. Always great to see you. And I think you're doing some presentations next week at Planet Microcap in Vegas. So looking forward to seeing you there.
Yeah, exactly. I'll be in Vegas next week. So if anybody's there, feel free to reach out. I'd love to connect with you. And thanks Adelaide, thanks Deborah and Victoria for having me. It was a pleasure to be here.
It was a pleasure to have you. So up next, we have our first presenter, which is going to be Pete Londa, CEO of Tantalus. Tantalus Systems trades on the TSX under the ticker GRID. Tantalus finds itself at an interesting position, being at the juncture of the electrification of everything and the modernization of the grid. So really exciting technology story that listed about 3 years ago in Canada, but has a long operating history. Here to tell you more about that's Pete Londa, calling in from Burnaby, I believe.
Worldwide headquarters, Burnaby, British Columbia. Deb, thanks for having me. And
yeah, thanks for participating.
Yeah, great opening keynote there. So appreciate you organizing that for all of us.
Great. Well, Pete, do you want to take us through sort of the background of Tantalus and what's exciting right now? I think we have a number of people that are unfamiliar with the story and a number that are familiar. So
sure.
Try and make it
okay,
new and interesting.
Well, hey, how about that? Is it okay if I share my screen?
Yep, go for it.
Let me know if this comes across.
Nice looking presentation, Pete.
Yeah, so to that end, thanks for helping us clean it up, Deb, and style it a little bit. So good morning, and for those on the East Coast, good afternoon. As Deb mentioned, my name is Pete Londa. I have the privilege of serving as president and CEO of a company called Tantalus Systems. What I'll try to do is provide a very high level summary of who we are, and then certainly ensure we have some time for Q&A, Deb. A number of attributes that were just shared during the keynote are very applicable within our model. So helpful to get that perspective and insight as investors are evaluating tech companies that fall under the $100 million market cap threshold. Just fast forwarding here, very high level of our organization. As Deb mentioned, we're on the Toronto Stock Exchange under the ticker symbol GRID, G-R-I-D. And the ticker symbol ties directly to the purpose of our organization. We are a technology company that is focused on helping the electric utility industry modernize the distribution grid. For those of you who may not be too familiar with the utility industry in general, there are utilities who focus in the world of generation, transmission, and then distribution. Some cross over a few of those categories, and some are just very specifically oriented. Our focus is not generation and transmission. It is the distribution grid. And the distribution grid is what you see in the neighborhoods where you all live and work. It's the substations, the power lines above ground, below ground, all the way to the meter on the side of homes and apartment buildings. And then as we continue to expand capabilities, the devices behind the meter inside the home or apartment or building that can help utilities mitigate imbalances between the supply of electricity and the demand of electricity. As an organization, we've been pretty fortunate to scale. Today, we have over 285 electric utilities deploying our technology. It's a pretty comprehensive platform that we deploy. The vast majority of those utilities are in the United States. So to previous comments, our revenue profile, over 95% of it is from the US today. As a result, we report in US dollars, a bit of an anomaly for companies traded on the TSX. So sorry for the confusion there. But quick high level summary, last year, delivered $42 million of revenue. That's growth year over year from 2022. And when we look back at 2021, we reported around $32 million of revenue. So pretty healthy growth over the last 2 years. Within our revenue mix, we have a combination of devices, intelligent edge computing devices that get physically deployed in the field, at the home, on power lines. And then from those devices, we collect data, and that data drives revenue contributions from software and services. Within our total revenue mix, 35% of our revenue comes from software and services, and embedded within that amount, about 24 to 25% of total revenue comes from annual recurring sources. Going into this calendar year, we have approximately $11.5 million of recurring revenue. Our ARR is reported on a rolling 12-month calendar basis. In terms of gross profit margin, a big area of focus for us as we seek to drive operating leverage as we continue to scale our company. Last year, 2023, we reported the highest gross profit margin in our company's history at 52%. I'd noticed the $42 million of revenue, also an all-time record for our organization. Very briefly, so what do we do? And what are utilities focused on? And why are they purchasing, deploying, and utilizing our technology? At the highest level, utilities have historically focused on the left side of this slide, from areas inside the substation to the power lines and devices called transformers that sit at the top of utility poles. They look like very large beer cans, for those of you who may not pay attention to them, and then down to the meter. And over the years, last 10, 15, 20 years, utilities have at least started to automate aspects of the distribution grid. With that said, it is an analog system, meaning very limited digitization and very limited visibility, command, and control of devices that the utility has to manage. Our history and our revenue profile comes from the left side of this slide. We have a suite of solutions, devices, edge computing, software, and services that help utilities begin to digitize and automate capabilities from the substation, down the distribution power lines, to the meter. And while some investors just categorize us as a smart metering company, because that is an element of what we do, I'd say that's really not a detailed perspective. For Tantalus, a device, whether that's under the glass of a meter, hanging on a power line, or in the substation, is a means to an end. The end is the data. And as we continue to accumulate data from these devices, it's driving an increasing contribution of revenue from software and analytics. One element of our organization that we think is unique is we've gotten pretty good at thinking through voice of the customer. And on an annualized basis, we host a users conference comprised of existing customers, as well as some prospective utilities that are evaluating us as a partner. This year, we included the 5 covering research analysts that are tracking and writing about Tantalus, as well as some investors who attended. And Deb, who attended as well, who manages our investor relations, can attest it's a fairly unique event and something that's very important for our organization. And the reason why I highlight that is because in the middle of this slide, you'll see the grid edge and a circular device called the TrueSense Gateway. The device that you're looking at on this slide is the output of our voice of customer surveys from about 3 years ago. And part of the rationale of Tantalus to go from privately held to publicly held and migrating over to the Toronto Stock Exchange was to access capital to bring this new capability into the utility market. And while I'll talk momentarily about the uniqueness of this device, what we have focused on, based on requests from customers and utilities that we support today, and some who are prospective customers of Tantalus. What was emerging is, as we think about reliability and resiliency of the grid and Tantalus, utilities continue to have an increasing amount of stress and anxiety and concern about the impact of electric vehicles, rooftop solar installations, power walls, and smart appliances that we as consumers are adopting, and how those devices are going to impact the integrity, the resiliency, and the reliability of the distribution grid. In particular, as electric vehicle chargers are added to the grid, that has a direct impact not only on the meter that delivers power to a home or a location where that EV charger is installed, but it impacts the power lines in terms of heat, and it most importantly impacts transformers that sit on utility poles. The reason why utilities are concerned specifically about transformers is that since COVID, the lead times to purchase a transformer have gone from 8 to 10 weeks to over 2.5 years. And the cost in some circumstances has quadrupled. Not only is there an increased demand for transformers globally, but one of the key components inside those transformers is a resin. It's the same resin that's being used for electric vehicle batteries. And so there's a shortage of that resin in particular that leads to extended lead times and higher prices. And whereas utilities have historically run transformers to failure, meaning let the transformer blow, people call to complain about a power outage, running devices to failure is no longer acceptable in today's world. It has an economic consequence to the utility. It certainly has an economic and potential life-threatening risk to customers. So the TrueSense Gateway was developed in conjunction with utilities to start to solve that problem. The problem being, as EVs show up, as rooftop solar installations get more broadly adopted, as storage devices inside the house materialize, how are those devices going to impact the integrity of the grid that we all rely on every single day? And that's what the TrueSense Gateway is geared to do. A couple of use cases that we're really focused in on with utilities, one of which is just enhancing metering capability. Not somewhat surprising, 20% of the meters in the United States, electric meters today, are still read manually. And just think about that in the context of even this call. We're all virtual. We're all online. We're all leveraging IP. We're all consuming power. I can personalize this where I grew up in Elizabeth, New Jersey. If you've ever flown into Newark Airport, that's Elizabeth. Big port, very industrial, very densely populated area. The meter on the side of the home where I grew up is still read manually once a month with an individual who writes down a meter read, goes back to the utility, publicly traded organization, mind you, on the New York Stock Exchange, generates a bill through their system, sends the bill to my parents. It's archaic when we think about having access to data in the palms of our hands and in our pockets every minute of every day. And so just enhancing metering infrastructure is certainly a key component of what we're doing. But what we've been able to do from a technological perspective is take very granular power quality measurements that typically are done at the substation level, and from an economic perspective, brought that technology down to every meter socket, every home, every business. And the reason why power quality is so important is as things like voltage and current start to fluctuate, it has a cascading impact on assets, whether that's inside our home, the lights are flickering, a refrigerator's burned out, a TV burns out prematurely, or for the utility, squirrels on power lines chewing away at insulation, trees hitting power lines that can lead to a fire, pole top transformers failing, outage, worst case, explosion, fire. We can predict and identify where issues are unfolding based on power quality measurement, the data from this device. We've also come up with a way for utilities to send a communication signal into the home, into a building, to ultimately have visibility and eventually command and control of the EV charger, of a water heater from one of our partners, GE Appliances, of a circuit breaker inside a home in an electric panel with one of our partners, Savant Energy. And some of you may say, why on earth would I give an electric utility the ability to turn on or turn off the EV charger at my home or the water heater? And the answer to that question is one, economic incentive that utilities are starting to deliver to us as consumers. And the second is, in some circumstances, I'll personalize it as the owner of an EV. I'd much rather have the inconvenience of charging my vehicle as opposed to a power outage that impacts my family. In terms of commercialization, this has been a 2.5-year R&D effort since the idea percolated 3 years ago from our customers. We've been developing this with 8 utilities as part of an advisory committee, which has now grown recently to 9 utilities. There are a few versions of this. The first version is a device that connects directly to fiber optics that utilities leverage in the field. And as of Monday of this week, it is now available for sale and being deployed by utilities. The Ethernet version is an extension of the fiber capability, and we are building a cellular version with Sierra Wireless that can ride on 5G or private LTE from a communications perspective. In terms of why we've been going down this path, the advisory committee that's helped us build this product, that has helped us test it, and now starting to deploy for their field trials and ultimately full deployment, represent an incremental $150 million of revenue opportunity for Tantalus over the next 5 to 7 years. That revenue is not backlogged today. We are starting to get orders out of that $150 million, and we'll be excited to continue to report on that as we make more progress through the calendar year. But we have a very good view as to where that revenue is coming from, which utility and when. We've invested about $11 million in R&D. So from the advisory committee alone, we're in excess of 14, almost 15 times return on that R&D investment. Beyond the advisory committee, we are directly engaged with about 30 incremental utilities. We would refer to that as qualified and identified, that represent an incremental $350 million of opportunity. And for those of you who have maybe tracking Tantalus, or for those of you who may start to track Tantalus as a result of today's conference, if you look back a few weeks, you'll see recent announcements. One from announcing our first win for the cellular gateway with an investor-owned utility in the United States based in Connecticut called United Illuminating, massive milestone for our organization. They are one of the 30 utilities in this qualified pipeline. And a second win announced about 2 weeks ago, a city in Tennessee, the city of Bolivar, selecting Tantalus as their partner using the fiber version of our TrueSense gateway. Another utility outside of the advisory committee already starting to move. So in the aggregate, we think we've got pretty good visibility into over $500 million of opportunity to scale our business over the next 5 to 7 years. And we are looking forward to sharing some incremental news and updates along the way. Last but not least, from a capitalization perspective, we're pretty fortunate. A fairly clean cap structure, 100% common stock, no dilutive securities or warrants behind it. 5 covering analysts that have been very active with us. And since the beginning of this year, I'm certainly starting to see the wave that was presented by our keynote speaker on incremental liquidity in the stock, incremental trading volumes, and in conjunction with that, a nice beginning recovery to our share price. Deb, with that, I hopefully it's a quick snapshot of who we are, and would turn it over to you for questions.
Yeah, thanks for that, Pete. I don't see any audience questions, so you're stuck with mine for now. If anyone wants to save you from that, just type in a question.
Yeah, please. Appreciate it.
So now that you've achieved UL certification, how quickly do you see the rollout of the TrueSense gateway, and when do you anticipate meaningful revenue contribution.
So let me talk to that in the context of our revenue model, especially in light of some of the comments about deferred revenue and recurring revenue models. So let me describe our revenue model, and then I'll put that into specific context on the TrueSense Gateway. The model for us is to convince an electric utility through our sales organization, people on staff, as well as a sales channel, about 20 sales channel representatives spread across Canada and the United States today. We work to convince a utility that we have the right technology, the devices, the software, the services, to solve very specific problems that they are prioritizing. And within that, we see immediate revenue from the sale of the physical devices, the edge computing devices like the TrueSense Gateway that get installed in the field. Embedded on all of those devices is a software license. We today use a perpetual software license that goes on that connected device. And then as part of that perpetual license, we generate a 22% annual maintenance fee into perpetuity. For us, devices are typically deployed 12 to 15 years is how we model. With that said, we have some utilities that have deployed some of our earlier generation technology that are now entering their 20th year of leveraging those devices and continuing to pay maintenance on the software license as we go. So we have a really nice stream of recurring revenue from those software licenses. We've also introduced, using machine-to-machine learning, data analytics tools that utilities can purchase from us on a SaaS offering. And so that's a part of our recurring model as well. So a nice blend of both revenue upfront that covers OpEx, provides cash flow to the business, and then longer term planning, recurring revenue that we can count on each year. As it relates to the TrueSense Gateway, and what we've shared publicly is we anticipate to start seeing some revenue materialize Q3 and Q4 of this year, so second half for us, order of magnitude $1.5 million to $2 million. We've just activated the first production run of the TrueSense Gateway in conjunction with our announcement earlier this week of the certifications required to put a device in the field. And we've got a pretty good idea of where the first 5,000 units of these gateways are going to go. From there, order of opportunity, order of magnitude between the advisory committee and utilities that are either through or actively involved in our sales process. 2025, sort of from a planning perspective, we're thinking an incremental $8 to $10 million of opportunity. That's risk adjusted out of almost $40 million of opportunity just from those first 30 plus utilities identified in our advisory committee. For 2026, for planning purposes, we're thinking an incremental $17.5 to $20 million US dollars of revenue. It's almost 50% growth top line between 2024 and 2026. I'd highlight that that's a risk adjusted number out of almost $100 million of identified opportunity for 2026 today that we're actively pursuing. So I think that's, we'll start to see and be able to share with investors and the market, I think, a quick inflection in our model from a revenue perspective. And then from the sale of those devices, fairly substantial recurring revenue on a per device per year basis. And where that sort of magnifies itself, Deb, I'll just steal one more slide here. When we think of ARR, you can see our growth of the recurring revenue, I think, codifies the model. Devices, from devices data, from data monetization. And since 2016, almost a 20% compounded annual growth rate, from about $3 million of recurring revenue in 2016 to now entering 2024 at over $11.5 million for this calendar year that will generate. So nice, healthy stream here of revenue. Not only provides more predictability in our business, but certainly improves our gross profit margin and profitability. Hopefully, it's a lot of context there to your question, but hopefully I covered it.
No, that's great. And how do you plan to finance the rollout of the TrueSense?
We've got inherent in our model, and we draw this out in our MD&A for those that actually read. the MD&A sections for reporting companies. We've got a really interesting working capital model that we've built over the years. So the edge computing devices that we build are done by a contract manufacturer out in Southeast Asia, the Philippines. We've used that contract manufacturer now for over a decade. So long-standing partnership for us. We've negotiated pretty favorable terms in that a lot of the components and bill of materials sit on their balance sheet. They invoice us when a finished product leaves their factory. The payment terms to our contract manufacturer are greater than the payment terms to our customers, the utilities. And the way we've negotiated pretty much all contracts with utilities, there are always some exceptions, but we invoice utilities as soon as the device with software embedded on it leaves the factory in the Philippines. The net payment terms from customers is about 30, 35 days. In some circumstances, 40. The net terms for our contract manufacturer are closer to 90 days. So we have, hedge is the wrong way to put it, but we have a really, I think, seamless and scalable working capital model where we're able to collect revenue from customers before we actually have to pay supplier. That can lead to some wonky working capital numbers on the balance sheet at quarter's end from a reporting perspective. But it allows us to start to scale this business more aggressively with the TrueSense Gateway without having to go out and dilute shareholders and raise incremental capital to support working capital. You know, at some point it may make sense to strengthen the balance sheet, Deb, but we can scale this business this year, next year, and even into 2026 with the working capital and the terms that we've negotiated with customers and vendors.
Okay, and taking a step back, can you share an example of a utility that is advanced and utilizing a modernized grid and how Tantalus is helping them?
A great example for us is a utility that supports the city of Chattanooga in Tennessee. Not quite 500,000 residents in Chattanooga, but it sits between Nashville and Atlanta. And long ago, Chattanooga was a hub for manufacturing, industrial businesses that had factories. And over the years, as those jobs and that effort left the United States and went overseas, Chattanooga went from a vibrant economy to really a dormant city. The electric utility is actually owned by the city there. It's a public power utility called EPB, the Electric Power Board of Chattanooga. They support about 200,000 homes and businesses that are where the residents of Chattanooga live. And in about 2010, we started working with EPB on first time any utility has done this, taking fiber, bringing it all the way to the home, not only to backhaul data from homes and meters, streaming that data, but also to deliver broadband services to compete head-to-head with Comcast, one of the large cable providers in the US. And they leveraged our first generation technology. EPB is the anchor member of our advisory committee, and the TrueSense Gateway is their path to upgrade from first generation technology from Tantalus to now the TrueSense Gateway, our latest and greatest device. They've got about 100,000 legacy products installed, and over the next several years, they will upgrade all of those to the TrueSense Gateway. That utility is leveraging its fiber network and advancements in edge computing at meters and line sensors and substations, where they have the first self-healing grid in the United States, if not arguably the world. It is one of the most advanced centers. And you may ask, why on earth would that be in Chattanooga? The reason for it is there are a number of US government research labs in and around the Chattanooga area that fall within EPB's footprint. And so the city of Chattanooga actually is of national interest to the United States government. And so advancements and investments in that grid have been profound. We've fortunately been and continue to be the beneficiary of some of that money. And so that's an organization that in real time can identify where a device is about to fail and roll a truck proactively and a team to go solve that problem before it cascades into power outages. And when we think about power outages, not only the inconvenience and the headache in my home with two teenagers who live and die by what's on their phone. So no power equals no Wi-Fi, no power to the phone because they have to charge it twice a day. So we'll talk about parenting skills separately, Deb, but right, that's a cascading impact for business. No power, you got economic loss. So that's an organization, EPB, that is at the cutting edge of really thinking through grid resiliency, reliability, and sustainability. And we're very fortunate to now be entering our third decade of relationship with EPB and really bringing this next generation technology, the TrueSense Gateway, into the market with them.
That's so interesting. I could ask you questions, Pete, all day. I find your business very fascinating. But you finished that question perfectly on time to wrap up your half-hour session. So thanks for taking the time.
Yeah, thank you, Deb.
For anyone that's new to Tantalus, there's many videos on the Adelaide Capital YouTube channel, and hopefully we'll be doing some more in the near future. So yeah, thanks, Pete. Thanks for presenting. I think Vic's going to introduce our next guest.
Yeah, thanks, Pete.
Thank you, Vic. Thanks, Deb. Bye-bye.
So next up, we're going to hear from Wishpond Technologies. They provide digital marketing solutions to small and medium-sized businesses across a variety of industries. They trade on the TSX Venture under the ticker WISH or WISH. Easy to remember for everyone. Ali, thanks for joining us today.
Thank you very much. I'm very happy to be here. Yeah, it's very easy to remember our ticker, but also there's a US company called Wish that sometimes people confuse us with them, and it's not always a good thing.
Okay.
Yeah.
Do you want to share your screen and pull up your presentation?
Yeah, let me do that. Okay, perfect. Can you see my screen right now?
Yeah, perfect. I can see it. So I'll pass it over to you. If anyone from the audience has any questions as we go, if you just type it into the Q&A box, then at the end we'll do a Q&A segment and we'll be able to get to them. So with that, Ali, I will pass it over to you for now.
Perfect. Thank you very much, Victoria. Great to be here. Thanks everyone for tuning in. So I'm the CEO and founder of Wishpond. Wishpond is an all-in-one marketing platform targeting small businesses and serving small businesses. We've been around for a number of years, went public about 3 years ago, and we serve more than 4,000 businesses from around the world. 74% of our clients and revenue comes from United States, and the remainder is across the globe. Canada, Europe, Brazil is a geography for us. And overall, Wishpond is quite interesting for a number of reasons, because it's the leading all-in-one marketing platform for small businesses, and I'll talk about some of their challenges shortly. But also, there are interesting things about our revenue and the way we work. Substantially, all of our revenue is recurring subscription-based revenue. We enjoy margins of about 65%. And since we went public December of 2020, about 3 years ago, we've grown the revenue from about $8 million annually to more than $24 million run rate right now, and increasing. So more than 3 times, and I'm very excited about that. Through this time, we also made a number of acquisitions to bolster our offering and make it stronger for small businesses. So the main problem is that we know obviously consumers are spending all of their time, or substantial amount of their time online on digital mediums, and businesses know that that's where they need to spend time. And for most part, they have websites or social media presence or something like that. But unlike large businesses, small businesses kind of fall short when it comes to digital marketing and online customer acquisition. Large businesses have armies of marketing professionals. They have a chief marketing officer. They have designers and copywriters and access to agencies, and they can sign up to 10 different marketing tools for different parts of the customer journey and pull them together, and they can spend for advertising and a lot of things like that. When it comes to small businesses, they're busy running their business, they're busy serving their clients, and they don't have the technical know-how, marketing know-how, access, the financial, the free hand to be able to make the investment. And because of that, a lot of times they try to do some things that are point solutions. So for example, they might say, okay, I've heard referral marketing is great. Let me just do some referral marketing and maybe I'll grow. So they do that. They don't necessarily get the success that they need. They move on to another tactic, as opposed to larger businesses that they have a framework for their growth and that's how they go. So what Wishpond does, though, is that we bring everything they need in one place. We give them a comprehensive platform that takes care of all the different touch points with their customers so that they can operate the same way a large company would be able to operate, and give them that benefit at substantially lower costs, starting at $300 a month. And as part of the onboarding, when we start with someone, we actually do the heavy lifting. We give them our copywriters and designers so that when things are set up, they're set up for success. They have their chance for success. So let me play a 2-minute video about Propel IQ. Hopefully you can still see my screen here to clarify what Propel IQ really does.
Are you ready to take your small business to the next level? Propel IQ is the all-in-one platform designed to help you thrive like a big company without breaking the bank. With Propel IQ, you'll unlock a comprehensive set of tools to manage your entire customer journey, all in one place. Say goodbye to juggling multiple logins and expensive software. So how does Propel IQ work? It's simple. First, create a powerful website using our AI-powered website builder. In just minutes, you'll have a professional online presence that attracts customers. Next, use our lead generation features like online forms, pop-ups, and landing pages to bring in new customers. Easily manage these leads in your central database to personalize your customers' experiences. Keep your customers engaged and purchasing with automated email marketing and SMS marketing. Save time and see more sales. Manage your business smoothly with an appointment booking calendar and a CRM that keeps you updated on your customers' behaviors. Want to reach out to potential customers? Our advanced sales outreach platform helps you do just that. And don't forget our referral marketing solution, helping you generate word-of-mouth buzz around your brand. But Propel IQ is more than just software. Our team is here to support you every step of the way. We'll help you set up your website, develop an email marketing strategy, and ensure everything runs smoothly. And if you ever need extra help, our expert marketing services are just a click away. Get access to SEO, graphic design, copywriting, and ad management, all from Propel IQ. No other marketing software offers such a comprehensive solution in one package. Say goodbye to the hassle of connecting different tools together. And the best part? Propel IQ is the most affordable solution out there, considering everything it can do. It's revolutionizing the way small businesses grow. So if you're ready to grow your business the smart way, it's time to equip yourself with the right tools. Propel IQ provides everything you need to outpace the competition, generate more sales, and turn your business dreams into reality.
Okay, so high level of it also, as the video went through it, Propel IQ touches on all the different touch points that a customer has with the business in terms of the customer journey, that buying journey. So that means that if you want to have best chance of success with online marketing and sales, you need a framework, and Propel IQ gives you that. To be able to do that, you need to be able to attract leads first. So we have all the different components for website builder, pop-up, different campaign types to attract leads. Once you've attracted the leads, you need to be able to nurture them with email marketing, SMS marketing, and different touch points so that people, you can earn their trust, and they can say, okay, I'm comfortable with you to want to transact with you. You also need to be able to manage the leads that you have. So we have a leads database and CRM capability so that you can see exactly what's going on with your prospect. And then ultimately, you want to turn the happy prospect or happy clients of yours into a word of mouth engine. Wishpond's referral marketing engine allows you to do just that. The other element that is key, and some of it you saw in the video, some of it we'll talk about shortly, is the use of AI. Over the past year, we've announced and released 4 AI products, and we're very excited about them. I really believe that AI is here to revolutionize a lot of industries, and marketing, I think, actually is one of the areas that is most primed for disruption. And when it comes to small businesses, I think that's actually a very exciting prospect, because it means that small businesses that historically haven't had access to those really skilled workers or didn't have the budget for it, now they can start to benefit and reap those rewards in a way that is affordable for them. So we rolled out, as we saw in the video, AI-powered website builder. 20 seconds, 30 seconds, you have a new website. You can ask it to revise the website, translate the website, generate new images for you. All of those things are built into it. We rolled out, Braxy AI ad management so that you can, automatically optimize the ads as they go along. We rolled out AI email responder, so if you get a lot of emails and you're busy, you don't want to be inundated by that. You want AI to be able to answer that. And then the other one that we announced that is a flagship product of ours, very exciting, and really first of its kind, is Sales Closer AI. That basically is an AI agent that can do Zoom calls or answer phone calls or make phone calls on behalf of your business to, whether the use cases for sales or support or technical support or answering training questions or take orders or talk to cold leads. It's a platform that allows you to scale. It talks naturally the way any of us would talk, and share a screen and show you products and functionality. So overall, where we're going with AI at Wishpond is that we want to be at the forefront of it. We believe that we can work towards a marketing co-pilot that can be your best chief marketing officer that you can go to and ask it to generate these different campaigns for you, give you insights, revise things for you, spot opportunities, and so forth. And we're working on some of those elements right now. So for Sales Closer, I can talk about it, or you can actually see that. I think there's nothing quite as powerful as seeing it in action. I have another video that I want to play for you. Hopefully, you will enjoy it.
Sales Closer AI, the first AI sales agent.
Hi, I'm Sarah. Welcome to our website builder demo session.
Imagine an agent that understands the nuances of your business and is able to take calls as you sleep. Imagine an agent that can speak any language and who understands exactly what to say and when.
Hola, ¿cómo te puedo ayudar?
Building an agent is simple. Just input your details, give your agent some context, and provide the agent with information you would give to any new hire. Next, give your agent basic instructions and instantly, your AI agent is brought to life. Now, imagine initiating discovery calls where your agent understands and adapts to your customers' needs in real time, building rapport and uncovering opportunities.
Are you looking for carpet cleaning, upholstery cleaning, or area rug cleaning services?
Area rug cleaning.
Great choice, Kevin. Are you based in Vancouver for the area rug cleaning service that you're interested in?
Yeah, I live downtown.
Thanks for confirming that, Kevin.
Encountering objections, your agent skillfully maneuvers, reframing problems and reiterating pain points. And because Sales Closer understands your knowledge base, it's able to effortlessly answer questions that would take years to train on.
At this stage, would you prefer a different incentive for capturing potential leads on your funky sock website in Vancouver, especially targeting parents and friends for gift purchases?
Yeah, so I don't know. We're not huge on giveaways. We think it kind of cheapens the brand.
I completely understand your concern about maintaining the integrity of your brand image. We can definitely explore alternative strategies that resonate more with your brand values.
When it's time to close a sale, Sales Closer AI takes the lead. With clear next steps in mind, Sales Closer artfully turns the conversation into customers.
The next step would be to schedule a call for a kickoff meeting where we can introduce you to our team and start working together.
We are very early stage startup. So can we do some negotiation on the payment side?
We can discuss terms based on your current stage. I understand your position as an early stage startup. Let's discuss your specific needs further on a kickoff call so we can tailor our approach. When would be a good time for this call?
Tomorrow at the same time?
Great.
Data is relayed in real time, ensuring no follow-up is missed, and can even be personalized on behalf of your team. So it feels like a real person is guiding them every step of the way. Experience a new way to communicate with customers that breaks down time zones, bridges language gaps, and accelerates training. Experience Sales Closer AI today.
Okay, so continuing, by the way, one really cool feature of Sales Closer is that you can also clone any voice. So in some of the elements or segments that you heard in that video, you might have noticed that it sounded like me because one of the things we did was cloning my voice for some of the AI agents. It made it sound more natural. Okay, we're moving on. So we have a lot of different customers that have used us over time, and I don't want to spend too much time on this, but you can see one example where a client joined us. They sell vegan protein bars, and they were selling mostly through retail distribution channel, basically working through others or wholesalers, and they wanted to be able to sell directly on their website. When they joined us, they had 6,500 email subscribers, and they knew that that was the key because they don't want to constantly have to advertise to get new customers. And we helped them grow that 23-fold to about 150,000 email subscribers. Another client on the right-hand side, before they came to us, 8 months before coming to us, about $900,000 of sales after $4 million. And obviously, each client is different, and we can't solely take credit for these, but definitely the platform and the service that we provided were quite essential in them achieving these goals. Now, thinking about about Wishpond in general and where we fit in the marketplace, there are a lot of marketing tools out there that you see on this left-hand side, and these are point solutions. So one product that is for referral marketing, one product that is for building a website, one for sending emails, one for advertising, and so forth. And you see, I mean, there are way more players, but you see in terms of the density of the dots here. But when you think about small business, they don't need any single one of these. They need a framework that actually captures a lot of these things and the interplay between them. So you need something all-in-one. That's the right-hand side. And within all-in-one, vast majority of the platforms that are all-in-one with the huge investments that those technology providers have put in them are on the more expensive side or geared towards enterprise clients. There aren't tons that are on the cost-effective all-in-one side like Wishpond, and Wishpond is quite unique in that. And now with the AI initiatives that we've added, it's becoming more and more appealing by the day. All-in-one platform, really cost-effective. We have a service element on the onboarding to help our clients get set up on the right foot. Some of our competitors, even on the larger end, still they would give you the software and you have to hire an agency to set things up, and that might be a few $1,000s for you, right off the front of it. And with Wishpond, you don't need to worry about that. That's part of the onboarding in the first month. And we continue to innovate and add new functionalities to help our clients. Financial metrics of the company, I think the picture speaks louder than anything I might be able to say, but you can see we've had very smooth trajectory of growth over the years. And you also see that we are forecasted to hit $26.6 million of revenue this year and about $32 million next year. Those forecasts are by the analysts covering Wishpond, the 6 analysts from Beacon, Canaccord, Adelaide Capital, Haywood, Paradigm, and PI. We don't give out our own estimates. And then on the right-hand side, you see since 2019, we've been adjusted EBITDA positive, and we're growing that, and we're balancing the growth with investment in sales and R&D. We talked about this a little bit. More than 4,000 clients. 74% of the clients are from the United States. From different industries, e-commerce is 30% of our revenue. 20% is B2B, 21% services, and so forth. So it's very diversified in terms of the industry that we serve. We're really industry agnostic, and we also don't have revenue concentration on any given client. There's one client, our larger client, that is 4% of the revenue, and aside from that, we have no one that is above 1%, and that's quite appealing for us, and it helps us as we go through any market changes. And here you also see the average monthly revenue our clients pay have consistently grown every year. So from $188 per month that the clients were paying us to now $570. And that allows us to also be able to do better with sales expansion and going and spending money and getting new customers. So that brings me to this slide, which is one of the elements that is actually very interesting about Wishpond, and to some extent unique, is our customer acquisition pipeline. We have a very predictable sales engine, and where $1 investment in sales gets us $3.8 return in the same year. And that is really top percentile in terms of the SaaS companies out there. And we've turned this into a very predictable engine that has manufacturing level precision with our lead generation engine, passing those leads to an SDR team to, cold call or cold email to prospects and find prospects that might be interested, and then setting up demos with our account executives who then give the demo and close the deals. We made 6 acquisitions since going public. And what's interesting about all of these 6 acquisitions is that they've all been integrated into Propel IQ. They've all been companies that have been profitable, and we didn't overpay for any of them. We paid anywhere from 1.1 time multiple to close to 3 time multiple of sales to them. They are also serving part of the customer journey that now is part of Propel IQ. So they helped us become stronger and more powerful, and they brought customers, and they're recurring revenue, and they have the same margin profile of about 65%, 70% that we have as a whole as well. Since going public, we listed the company about 3 years ago at 75 cents, and the stock price right now, unfortunately, is below that, even though the revenue is 3 times larger. Another element to also remember is that the insider ownership is more than 40%, is a relatively tightly held stock. There have been a lot of macro things affecting small cap tech. We see since the beginning of the year some recovery on the price of the stock. When we look at the comparables, whether they're the US counterparts, some of them on the larger side, some of them on the smaller side, or we look at the Canadian recent acquisitions like Media Valley and Quantiform and so forth, we see Wishpond is really undervalued, underpriced. So the larger ones trading at 7 times multiple of sales. We're basically trading at 1 time multiple of sales. And the 2 acquisitions that I mentioned, Media Valley and Quantiforms, trading at about 3.6, 3.8 times multiple. And Wishpond's profile in terms of profitability, in terms of growth profile, in terms of innovation with AI and all of those, and the addressable market size, I would argue actually makes it more appealing to a lot of players that we see here. I would like to believe that sooner or later the market will adjust in terms of the price. Now, that's everything I wanted to cover about Wishpond. So again, a company more than $24 million annual revenue run rate, more than 4,000 businesses we serve, strong recurring revenue, healthy balance sheet and adjusted EBITDA profile, leading all-in-one platform, a management team that has been in the trenches with marketing tech for years, and growth driven by sales and marketing and new AI products, and undervalued compared to our peers. And with that, if there are any questions, I would be happy to answer.
Thanks, Ali. I have a few questions here. It was great to see the videos. The AI stuff is creepy and fascinating at the same time.
Yes, I can imagine.
But so a few questions. So what proportion of your customer base is full Propel IQ, like on the Swole platform now?
Right now, more than 10% of our revenue comes from Propel IQ, but it's one of the fastest segments of our revenue. So last year, for example, we started with no Propel IQ customers and grew that to more than 500 in 1 year. And the other thing that was also very interesting about Propel IQ, and the reason that we went there instead of the legacy products and the silo solution that we had, was that we wanted to make sure that the retention that historically for FMBs is harder to nail would be stronger with an all-in-one bundle. And we wanted to make sure that margin profile is even better than what we have right now. And we saw those to be the case. So we see that churn was up to 40% lower than the silo point solutions that we were selling ourselves under Propel IQ. We saw margin was showing to appear more than 80% compared to our 65%, and long-term value to be more than 20% higher. So those gave us basically the foundation for the next stage of growth, and building on top of that to get the company to the next horizon, that for the next milestone that we have in mind is 100 million ARR. So wanted to make sure that we're ready and prepared for that.
And then these AI products that you guys are offering, are they wrapped into the Propel IQ solution as well?
3 of the ones that I talked about, so website builder, email responder, and ad management, are part of Propel IQ. Sales Closer is an independent product, independent brand and website and all that. Some of the Propel IQ clients will benefit from it, and they get a separate subscription for Sales Closer, and there will be integration between the 2 platforms. But we do anticipate there will be a lot of use cases that are not necessarily tied to Propel IQ, and we don't want to, artificially tie them together.
Yeah. And then what are your competitors doing in terms of AI? Like, are they anywhere offering similar things to what you guys are offering right now? And then if not, how are you guys protecting kind of yourselves and your offerings?
We have different competitors. As far as I've seen, most of our competitors are not moving on AI as fast as we have been able to, and I'm quite happy about that. We do see some of the peers have got into AI-powered website build functionality. If they had a website builder to begin with, they've got into that, and various levels of sophistication and feature completeness. But to the extent that we're talking about for all the different components, no, it's quite rare. Sales Closer, none of our competitors in the marketing tech space all-in-one have got into it. It's very new, very exciting, and I think a lot of people that I talk to are quite surprised how quickly we were able to pull that together. We put a lot of resources and priority on that. And the other question that you had is about protection of it. I think there's 2 things related to protection. One is in terms of intellectual property, we filed a patent, and there will be subsequent patents that we're going to file to give us some level of defensive protection. But I think ultimately, the best defense actually in this case is offense, and moving fast and continue to innovate and always be ahead of the pack, and do great with customer acquisition.
And then I've been speaking fast because you only have a few minutes, and I'm trying to get these questions out. But just one last one is, in terms of, are there certain areas that you would like to expand into, or like other solutions that you would like to bring in still in terms of Propel IQ or just your service offering? And then when you think about those, is it a build internally, or are there still acquisitions that you guys are watching out there?
There are tons of acquisition opportunities that are still out there in a lot of different areas. Some of them are other AI initiatives that we haven't got into yet. Some of them are video production, live chat software, blogging capability. There are a lot of those ones. But right now, that's not really our priority. Our priority right now is really focusing on our own product capabilities that we built and improving them and making sure that they stick as well as we can, and continue innovating internally, as well as Salesforce. Salesforce is going to be where a lot of our R&D efforts are going to go into, because we see absolutely enormous opportunity there that we want to make sure we completely leverage and take full advantage of.
Okay, well, we'll end it there on the half hour, but thanks so much for joining us today. And you're going to be at Planet MicroCap next week as well, I believe. I think I saw you in that list.
Yes.
Okay,
yes,
perfect.
Right.
We'll see you there. And if anyone else is going to be at Planet MicroCap next week, then if you want to get in touch with Wishpond, they'll be there also.
Thank you very much. Thank you, Victoria.
Thanks. So next, I would like to introduce James Lormier from Data Communications Management. Data Communications trades on the TSX under DCM. James, can you turn your camera on? I just wanted to make sure he can. There we go. Hi. So Data Communications Management provides marketing and advertising services that help large brands simplify and manage their online and offline communication needs. There's my quick intro, but I will let James bring you through the presentation, and then we will be back with a Q&A afterwards. There we go.
Thanks for the introduction, Victoria.
Yeah, thanks for coming on today.
My pleasure, my pleasure. As Victoria mentioned, I'm James Lorimer. I'm the CFO of Data Communications Management. We do trade on the TSX as well as the OTCQX. We were recently, recognized by the QX as one of their best 50 stocks. And I think we ranked number 5 last year in terms of combination of trading volume and price performance during 2023. Remind everyone that we will be looking at and reviewing some forward-looking statements here. Cautionary statements are provided here and included in more detail on our public disclosure, which is both filed on SEDAR+ and accessible on our website at datacm.com. Get into a little bit about us in terms of what is data communications management. And, really at the core, our objective is to help our clients simplify the very complex marketing and communications and operations workflow systems and platforms that they have. We've been at this for a long time. While we were founded about 65 years ago, some of the acquisitions we've made actually trace their roots back to the late 1800s. We currently have a market cap that's about $170 million. On an enterprise or on a fully diluted basis, we're about $184 million. Unfortunately, Richard Kellum, who's our president and CEO, was unavailable to present today, but we certainly have him on a lot of our public communications. DCM at a glance. So last year we reported a little over $473 million in total revenue. That was up over 60% compared to the prior year. And a big contributor to that was a significant acquisition we made early in 2023, which I'll talk a little bit about shortly. Our business is really distinguished by long-term client contracts. We work with many of Canada's largest enterprise clients, and more than 50%, probably about 2/3 of our client contracts are under long-term contracts. So lots of kind of sticky, while not technically recurring revenue, it's very kind of consistent and long-standing client relationships. We have over 400 enterprise clients, about 1,800 employees across the country, and we have a small facility in Niles, Illinois, which is just outside of Chicago. So really our national footprint allows us to serve our clients really not only coast to coast, but also into the US. We have approximately 13 of those facilities would be kind of main manufacturing plants. We've got plans to reduce that by approximately 3 over the next 12 months. So we'll be down to about 10 core manufacturing plants. From a kind of profitability perspective, we generated over $53 million of EBITDA last year. That included just over 8 months of reported earnings from the acquisition that I'll talk about of Moore Canada. And we do generate strong free cash flow. Last year it was about $16.5 million, and that's taking our cash from operations less our capital expenditures. So definitely we have scale in the Canadian market. What we do, and why are we on a technology panel today? Really at the core of it, well, we're kind of a traditional print business. We really distinguish ourselves in the market by leading with technology. And really at the core of all our platforms is a platform we've developed over many years, which we call DCM Flex. And we call it Flex because it's very flexible. We've integrated that platform into over 80 different applications of our customers. And it's really a kind of a complex process for helping simplify the kind of complex workflows that our clients have. Really, a lot of what we do at kind of at the heart of our business is business process outsourcing, helping our clients manage that complexity, delivering personalized communications, and we augment that with some pretty innovative marketing solutions as well. We are second largest print and marketing communications company in Canada. Transcontinental would be the largest and really our largest competitor. But we're probably if you look at the print business, we're probably about half their size because they're also in a number of other businesses in which we don't participate. In terms of our client base, we really deal with blue chip clients right across the spectrum of a number of different vertical markets. Some of our key markets that we will profile include financial services, retail, government and related regulatory industries, transportation, and the lottery markets. Those would be probably the 4 biggest vertical markets. We also serve the healthcare and manufacturing and marketing agency world. So we have a very broad client base. If you look at some of the clients that we manage, if we were to, for example, pick a Bank of Montreal, they would have over 8 different lines of business, and we're active in each of those lines of business. And often we'll do very different things. But you think about the complexity of any kind of an organization that has tens, if not hundreds, or even in some cases, our clients, thousands of locations across the country, and getting the right printed material, the right collateral, the right marketing material to the right branch and at the right time is a real critical part of what we do. We're distributing products on a daily basis right across the country. And in the case of clients like Air Canada, we're delivering products basically anywhere they fly so that your boarding passes or your tickets or any other kind of marketing collateral is in the kind of proper destination. There's a number of key market trends that really are supporting our business. Hyper-personalization is something that's really been important. And there's been a real push over many years to really kind of personalize communications. And the more you can personalize a piece of direct mail or a digital marketing campaign, the better you can engage with your clients. And that's really what we do. We've made a pretty significant investment over the years in our data management and data integrity and the ability to kind of customize material, and whether it's varying names or data fields or even different pictures that would end up on a variable printed display. That's something that we're very capable of. As well, increasingly complex workflows in our clients' operations. And if you think about all the complexities of running a big bank or an airline or even a lottery company, making sure that the right material is in the right place and trying to manage how to manage the costs, and you're constantly changing logos or you have different lines of business. How do they communicate with each other? And often they're preparing material that is, kind of siloed. And so how do we help span across knowledge bases within different functions within our clients? Something that we've done really well at. And as well, because of all this complexity, a lot of our clients are looking to outsource non-core functions. They have a number of vendors that they're trying to consolidate. Our objective is to become, if not the sole source, certainly the primary supply source for many of our clients, and really take a lot of that kind of complexity of, pricing and quoting and consistency off their hands. Another big theme that's driving our business is really a focus on campaign performance. And if a client's doing a direct mail campaign or a digital campaign, there's a real increased importance of how do you accurately track how successful that campaign is being done and conducted. And that's something that we really excel at. There's certainly been a growth in marketing technology solutions, and Ali talked a little bit about that in the prior session. So I think these marketing technology solutions have really grown in response to the complexity that's out there in the world. Another impact that we're certainly seeing is industry consolidation. We operate in a very fragmented market, and there's certainly a number of opportunities for us to continue to be acquirers in kind of our core markets. As a case in point, the print market in Canada is about a $10 billion market. We're probably about 5%, and at that percentage, the second largest player. So beyond that, it's a very fragmented market, and we're seeing some really interesting companies out there. We've acquired, I guess, 6 companies in the last few years, and it's really been with an objective to increase our core capabilities and areas where we've identified that there's growth opportunities and margin opportunities to help support our business. I'd like to talk a little bit about a transformational acquisition that we completed in April of last year. We acquired our largest competitor, Moore Canada Corporation, a company that had previously been owned by R.R. Donnelley, which is a large print and marketing communications company based in the US. R.R. Donnelley, the parent company, had been taken private by a private equity group about a year before we approached them. And we had an opportunity to basically take over the entire Canadian operations of their business. So the total revenue is about $255 million. We paid about $135 million for the business, but the business came with 3 owned real estate properties. Net of the sale of those, we paid about $100 million for the business. That worked out to be about a multiple of about 4.5 times EBITDA. But really exciting opportunity for us because it almost doubled the size of the business. We've identified a significant amount of synergies in the transaction. We were really well prepared for closing the acquisition. We hired Boston Consulting Group to advise us on kind of pre-merger integration and post-merger integration. And so literally day one after the acquisition closed in April, we hit the ground running, bringing our sales teams together, bringing our operations teams together, and all our other various functions. We've identified at least $30 million, and we're striving for $35 million of synergies to realize from the transaction. And really kind of 4 buckets. The big 3 that we've really focused on in terms of those metrics are operational synergies, so opportunities to reduce our footprint, take advantage of increased scale and capabilities. Organizational synergies, which would include kind of redundant headcount. Everything in kind of SG&A, if you will, has been being looked at, and big change that we made was harmonizing our sales teams into kind of one organized sales group, very focused, and we reduced a number of our sales team back in the fall. We've also identified a number of procurement synergies, and these are allowing us to operate more efficiently because of our purchasing power now. We been able to kind of flex our muscle a little bit with some of our suppliers, improve terms, et cetera. And so with the kind of scale that we have now, it's really positioned us well for the future. As part of this, we're also really focused on paying down debt. Since the acquisition closed, which we did finance 100% with debt, we've reduced our debt by about 40%. That's including through some asset sales, as well as a private placement that we did back in May and June of last year. So we're really comfortable with the glide path that we have. Prior to the acquisition, we had net debt of just less than $20 million. Our objective is to get net debt to EBITDA down below 1x over the next couple of years. And we think we're on a very good glide path there. Let me turn a little bit to our financial performance. You can see our revenue in 2021 was about $235 million. We grew fully organically in 22 by just over 16%, and then significant growth with the acquisition of Moore Canada led to over 60% growth in 2023 compared to 2022. As well, our gross profit has been growing, and if Richard was here, he'd like to point out that gross profit growing faster than revenue is a good thing. In 2022, our gross profit grew by over 20% compared to the prior year to $84 million. And together with a real focus on cost control on our overhead, that's delivering a strong EBITDA as well. We did acquire a business that had significantly lower gross margins than ours, and we've got a path in place to grow our margins back to prior levels. You can see here our growth in adjusted EBITDA from $33 million in 2021 to just about $41 million in 22 and $53 million last year. And again, just point out that included about 8 months of the Moore Canada results. Here, wanted to drill in a little bit to show some of the kind of operational opportunities we have. Our business on the top left in dark blue was well above kind of trending nicely on a path to 35% gross margins, which was our kind of pre-acquisition objective. We reported 31 to 32% in the last couple of quarters before the acquisition. The Moore Canada business, very different kind of margin profile. On average, they're kind of 19 to 20%. Some strong performance typically in the first part of the year because of some of the transactional print statement work they do. You can see on a pro forma basis, after the acquisitions, we've been in the kind of 25-26% gross margin range. We have a plan in place to return to north of 30% gross margins, and we're executing upon that right now. We've also had a real focus on productivity, and we define that as revenue per associate. Associate is really kind of our what we call employees. We finished, 2023 just shy of about 1,800 employees. Right after the acquisition, we were actually closer to 1,950, almost 2,000 employees. So we've seen a little bit of headcount reduction since the acquisition. You can see our revenue per employee has grown over the years, and even with the acquisition, we're kind of north of $300,000 of revenue per employee. And it's an objective of ours to continue to grow that number over the next several years. So what's next? We've been really busy with our integration of the acquisition over the past year. So that's really our focus this year is making sure that our plant consolidation goes flawlessly. We closed one plant in November last year. We moved our Edmonton facility that we acquired into our Calgary facility. This year, we have plans to consolidate 2 plants in the Greater Toronto area and move one plant, which is in Fergus, Ontario, to Drummondville, Quebec, and then move the production from a plant that's located in Trenton, Ontario, into our Brampton facility, which is our head office and our largest plant. We're also kind of in parallel working on harmonizing all our back office systems. Really kind of the key result of the integration is going to lead to, or should lead to, further improvements in gross profit. As I mentioned, we want to strive to get our gross margin back north of 30%. And we've got a lot of number of active programs that we're engaged in to do that. We're also really focused on growing our business. We acquired some complementary product lines, and with the acquisition, we're really focused now on kind of leveraging our combined capabilities and growing our revenue, not only with our current clients and cross-selling to current combined clients, but also going after new logos. And as we continue to generate higher levels of profits, we certainly look forward to generating higher levels of free cash flow. In terms of kind of where we go from an acquisition perspective, there's three key areas that we're looking at. One would be kind of more traditional kind of print-related businesses, really targeting areas that have good margins, good client bases, an opportunity to integrate those into our existing network would be ideal. We're also looking at marketing services companies that don't have physical print, but one of their downstream byproducts might be print through other providers, and would allow us to capture some of that capacity, or some of that workflow, and bring that into our own systems. And then also in technology solutions, we really lead with technology in all our customer pitches, and the majority of the clients that we've acquired in terms of new clients over the past number of years have really been because we distinguish ourselves with our technology platforms. And so we're on the lookout for marketing technology applications that would be complementary to what we do, and help continue to kind of drive workflow improvements ultimately for our clients. So in summary, we're a leading provider in the Canadian market in our sector. We're very focused on profitable growth and growing margins, continuing to pay down debt and generate free cash flow. We're having really good success with the MCC integration. It is going ahead of plan. We're ahead of our original targets for synergy realization, and moving forward some of the integration plans from what we originally planned. So if we execute that flawlessly, then that should help continue to lead to further EBITDA growth. And then we're looking forward to, obviously, future growth, not only kind of organically, but also through acquisition, and some new technology product launches that we're working on. We think we've got a strong leadership team. We've got a good history in the market, buying and integrating companies, and particularly in growing marketing communications businesses. So with that, I'll turn it back to Victoria.
Thanks so much for the presentation, James. A few Q&A from me. Could you provide some examples of how your technology solutions are tailored to and then flow into a printed product?
Sure. It may be as simple, which kind of sounds simple, as printing business cards for our clients. Working with enterprises, we're certainly not a Vistaprint, but when we work with a client, the CEO's assistant could order business cards, so those would be personalized and printed and shipped, kind of same day or next day. Really, what we kind of pride ourselves is kind of more complicated things where clients might be procuring products to be shipped, across the country, and those might be finished goods that are sitting in a warehouse. But a branch in, let's say, Kelowna, wants some RSP material. They want some signage for the walls. They want some personalized communications for their clients. All those types of things can be, prepared and delivered through our systems. And our platforms are fully integrated into our clients' own marketing portals. So it's really kind of, our platform is really kind of indistinguishable from their own systems. We have capabilities to map an entire company's branch network. And so if they have a variety of different size branches or stores, we can make sure that we put the right type of collateral and deliver it to that store, so that if they have 5 windows, they have 5 signs that can go in the window. If they have 4, you can get 4 signs, but also all the kind of customized collateral that can be required with that.
And then as you guys look to, expand your digital offerings, are you guys looking to continue to have a more integrated approach to your technology? Or I saw that you guys had expanded. Now you guys have a data asset management system for clients. So are you guys also looking for technology solutions that are a little bit more standalone as well?
Yeah, ideally our systems and technologies will integrate with each other. We are developing a standalone digital asset management platform, and we plan to launch that in kind of early in the second half of this year. And really kind of the evolution for that, we've been managing digital assets for our clients for 20, 30 years. And so we're handling tens of thousands of digital assets on a daily basis, and we know how complex it is to manage those. We've had kind of our own kind of DAM product incorporated into our workflows, but we're developing a standalone product, which we think will have some competitive advantages in the market, and hope to launch that later this year. We also have a number of other kind of marketing application platforms that we've developed, and often they do integrate into our DCM Flex platform. And so opportunities to get our customers using our Flex platform, and then offer them additional technologies and capabilities to better manage their client engagement.
And then what did the technology side of things look like from the R.R. Donnelley acquisition? Did you acquire kind of anything within that acquisition, or it's more transitioning these clients now over to use your technology and your platforms?
Yeah, that's a really good question, Victoria. R.R. Donnelley globally is a big multinational company. And so they did have kind of an equivalent product to what we call DCM Flex. We're in the process of migrating any of their clients that use that platform over to our platform. And we've already migrated a number, and have a path over the next kind of, I guess, the balance of this year to migrate all their clients over to our platform. We think our platform has some unique applications and unique features that certainly will kind of better serve our clients. And I'd say that kind of by comparison, our client base is more engaged with our customer-facing technology platforms than the Moore Canada client base was. But we're certainly finding a very kind of welcoming client base as we move them over, and look to add additional technology capabilities into their client base.
And then this is an audience question, and so they're asking, how much is the digital component of your revenue now, and then where do you see this kind of trending in 5 years from now?
Sure. The digital component of our business comprises a number of different features and products. I think in 2023, we reported a total of about $13 million in kind of service fees. And that's made up of both professional services fees for everything from implementation to programming services, where we charge by the hour for work, to subscription fees for the use of some of our platforms. This is kind of the pure subscription fee portion of that is pretty small today, but we see that as a big opportunity. We've talked about growing our MarTech applications by 60% a year over the next 5 years, and so we've got a real focused effort to not only kind of develop and enhance those products, but to obviously get traction with our clients.
And then I know that you guys have spoken in previous presentations too about moving from a print first strategy to a digital first focus. So what are some of the biggest challenges that you guys are seeing as you guys embark on that initiative?
Yeah, I'd say, the kind of digital first strategy is something that Richard really kind of promulgated, I guess, when he started with us about 3 years ago. It was really kind of, discovering what we already had. And so, something that we've developed over many years, and we used to give it away to get the print. Now the focus is shifting to how do we kind of get more value out of that? How do we charge, enhanced fees for that? How do we, kind of market different applications to our clients? And I'd say that, there's a few sectors where we've had really good success, and particularly I'd say that would be in the financial services and the retail sectors. And you think about in the retail sector, I talked a lot about financial services, but in the retail sector, particularly in, say, the quick service restaurant world, where turnaround is very quick, customized menus, customized signs, and we've got some applications that really tailor well to that world, as well as direct marketing, direct mail campaigns. And so really it's not so much a matter of customers kind of pushing back on that. It's getting that kind of sell through, and I think we're making pretty good progress with that.
Well, thanks so much for being on today. I appreciate your presentation. You guys definitely had a busy last year, and it seems like this year is going to continue to be busy for you.
Yes, that's for sure.
Okay, well, thanks so much. I think Deb's going to join us back here for just some final thoughts for everyone.
Hi, James. Thanks for the presentation. Really interesting.
Thanks, Deb.
Yeah, so I just wanted to thank everyone for participating, for the presenters. Thank you for presenting, and for the audience members. Thanks for your participation and questions. Hopefully we'll do a few more sessions like this in the coming months. So if you have ideas of companies that you'd like featured, please feel free to reach out. Vic, anything else I'm missing?
Yeah, no, we'd like to get virtual again a little bit. We've been doing a lot in person. As I think, everyone's kind of come out of this COVID world and wanted to re-enter the world again. But we find a lot of value in this virtual content. And then also, we post it on our YouTube channel afterwards. So if anyone wants to, replay it or see it again later, it's always there.
Thanks, Vic, for helping me out today. And thanks, everyone. Have a good afternoon.
Thanks, everyone. Bye.